All right, hey everybody, what's up? It's the second video after the watch list video today because next week I'm going to be going into more detail on MES trading, micro futures, to be exact. And I want to just get everyone up to speed on what I'm going to do and how the show is going to change a little, just for a few days, because I want to do a little bit more focus on that. And I want to, we're going to try to add some sections to the site to cover more of this type of trading. And I want to put more time into it. I know because there's just a lot of people who do like the faster time frame. And the summer months right now, we're trading at the highs. We are seeing some good action, and I'm able to key in on some good things. But I haven't put my full dedication to it and really concentrated on. I'm always jumping back between stocks and futures and all over the place. So I kind of miss some of the setup. So I just want to point that out, that I'm going to be trying to concentrate a little bit more next week on that. A little bit more focus on that, and I would like everyone to who's interested in trading the futures to kind of join me in doing a kind of a not an experiment, but I want to try to stay to a set of rules and a blueprint and trade it all week and see how the results are. I want to stick to a certain amount of contracts, only take certain setups, and move up according to my business plan or my trading plan. And that's what I want to, and again, this video is kind of an introduction to what that's going to be like. And I want to go through a couple of the, the criteria right now and basically make its own little section, a little education that you'll get for next week if you want to catch up on it, or something new for you that you haven't, dove into any futures trading yet. This will be a good time to start. And I'll give some basics, and it'll be easy. It's going to be very, very logical. It's not going to be hard. It's going to be almost mechanical, but it's not going to be automated. Even though I do have automated tools, I do like to put the human touch to it. I like to analyze, what's going on with the market conditions, what time of day, and other things like that to really keep me in a trade or take me out early. But a lot of the entries will be just based off of the criteria, and I'll be calling those out aggressively and trying not to miss any of them, and trying to take each one that is a valid entry setup that I defined, and that you'll have the rules on it too. And and looking to make, and again, the topic of this is really going to be to make it catchy, trade in a small account. Trading, because we're trading the MES micro futures, which if you get a discounted broker, you could get margins on this for about $50 a contract. And if you're going to be trading according to the style and method I'm going to be trading next week, if you go up to 4 or 5 contracts, you're only putting up to usually about $200. And that's what you have to put up. Now that means that you could open up an account for $500 and trade those. So it's very interesting for people out there. Don't get frustrated because they don't have enough money to trade stocks with the pattern day trading rule. If you're under 25K, you're stuck with trading three times in a 5-day period, which could really limit your trading, plus also get you stuck in stuff. This, you have a much lower entry level. In some cases you can open up an account with $500. But I would recommend, and in this project I'm going to be doing, we'll be keeping it as we'll be trading if we had $1,000 in the account. So we'll take up enough contracts to be able to do that. All right. Which really you could take 20 contracts. But we're not going to go anywhere near that. We're going to stick to around 4 contracts, and I'm going to show you why, and we're going to get into a little bit more detail because we want to build up from that point. There's always a beginning point, and if you're starting to do this and you're developing things and you're trying to stick to a game plan, you want to get that you want to get those skills. In what am I trying to say? I guess you want to kind of get this, or your fine tuning of how you're going to be doing this with a smaller account, so there's not a lot of risk. And once you start to become comfortable and become confident in seeing how things work for you, then you go up in size. So just to start off a little smaller, under 4 contracts. But again, this is relative to each person's account. This is based off of having $1,000 and trying and learning and getting going trading futures. Now the micro contract is a little different from the S&P contract, or the E-mini contract, I should say. Maybe I'll give you a detailed look on that. All right, so we have the micro, E-mini, the E-mini, and then the full-size contract. And we're just going to worry about the micro and the E-mini. The E-mini here is $50 a point. The micro is $5 a point. All right, and you can see the difference. Tick value, 4 ticks to a point, and you just divide that down. You get that 5, and then you get that 50. So it equals out to $12.50 per tick versus $125 per tick. Exchange fees, contract months. But really, the basis is here. The amount of movement stays the same, but the price is much different. It's 1/10. It's I really enjoy it. I think it's an easy way to get started trading if you're unfamiliar with trading. So that's the basis of it. And again, we could probably do more research on brokers, but right now I could just tell you a few brokers I know are discount brokers. Ninja Trader is a discount broker. Infinity, I believe, is a discount broker. And there's some other ones. Stage 5 might be. Stage 5, Omar. There's a couple other ones out there that offer the $50 margin on the micro contract. If you have like IB, you're still paying a couple $1,000s for a micro contract. So it's big difference between that and that. So we're going to start Monday. We got to have our order entry criteria, profit exit criteria, automatic stop criteria, risk management. We're going to go over during the week. And again, we'll hit on all this during our trading. So it's going to be a kind of a hands-on webinar that's going to last a whole week on this. I actually have a great calculator which I just saved, and I'm going to be handing it out to the members also on Monday. I'll probably upload that to the site here, and you guys can just download it on your site. And basically, that's the calculator. Kind of takes what you're trading and makes it very easy. It breaks it down for you. Let me see if I have it available right here. I just had it. I was working on it, and there it is. Here it is. So I got it set up for the MES, and I actually start in the account side at 1,000 with the margin $50, and it calculates everything in here. Now we're going to start off in this. We always talk about risk, what kind of risk you want to take in trading. Now there's different ways of placing your stop. There is a technically you could do support lines or candles and stuff, but also you could do it by value of your account and how much risk you want to take. There's an old adage that you shouldn't risk more than 2-3% on a trade. Now, all right, I don't know who wrote that. It makes sense for some people and stuff, but I don't think that holds water across every situation, because there will be some great situations that we run across that they're very high probability trades, and that's the ones you really want to make money on. So you might want to step up on those, and I think that's what we need to define more. But this calculator will get you started if you are that type of personality that needs a rigid schedule and how to move up. You could put this. You'll download it. You could actually put your own. Put your own amounts in there, whatever your account size is and what your margin is. You can put that in there, and everything will be calculated for you. Position size is PS, and it just kind of puts things. If you're looking at a risk of 4%, you don't want to risk more than 4% a trade. That's what this is really breaking it down for when we talk about risk and how many contracts you want to have. So it brings you to probably about 3 points. You're risking about 4.5%. If you have three contracts on, and you have a 3-point stop, that's giving you a $45 loss, which is equal to 4.5%. All right, loss also. So it just kind of puts things out there for you. I don't really stick to the percentage game here. I stick to the divergence game, and that's how I define my stop. So sometimes the stop will be tighter, sometimes the stop will be a little bit wider. And what we mean by that is just by going back to the divergence rule here. I'll show you that one more time. If I go down to the divergence rule here. All right, so the buy side lower entry. Stage 1 divergence should have stochastic under 20. Then the low brings the stochastic back up to 20. You know, if you don't know what divergences are, that's why you want to be, tuning in next week. I'll be going over. I'm not going to go over what the divergence is right now, but going back and taking a look at it, we're going to have. There's going to be a detailed criteria. I mean, if the criteria doesn't fit, and there's another interesting thing back here. Let me see if I actually have it. Let me see. Hold on. Oh yeah, this course here. You guys are going to get this. Developing a trading plan. Now I broke this down. This is going to be on the School of Stock. We're moving the School of Stock behind to the Day Trading Radio server. So that's going to be in the Day Trading Radio servers. We're going to be doing something special for the members and opening up parts of it so you have access to these important lessons that are based off of next week if you don't have access to it already. So you're going to be able to read all this and get all this. But for position sizing, we talked about that. You're going to be getting this. Entry rules. I mean, I would just go through this. This is all good stuff. I wrote this up about a year ago, maybe two. And I just realized how much good information is on here. And these are going to be our trade triggers. You know, the divergences, reversal candles, multiple time frame alignments, meaning the 1 minute, 5 minute. And when all these things are setting up, or the playbook trades, you know, we have a divergence with a trend line or a 200 EMA breakdown on the future. But again, we're going to be doing futures, so most likely we're going to be just doing divergences, bull and bear 2020 flags. Impossible, just kind of snap back. The key is trying to wait for the setups and not getting too crazy on jumping in and out for no other reason. So I broke that down here. You can actually see there's a little better. Let me bring this up here. My trigger. All right, and then what I want to do with this: one tick under the divergence, the profit, first rotation to the overbought 14.3 stochastic. So in this case, we're going to be looking at taking the divergence, put the stop one tick under divergence low, or take profits off of the first rotation of the 14.3 stochastic. Well, not the 9.3, but the 14.3. Second profit, and we might want to scale out on that. Depending on how many contracts you have. If you have a really good setup, you might be in for 4 contracts, depending on, and we'll get to that point. You want to maybe take 2 off here and then keep another 2 on and for a further move higher, moving your stop up to break even. Also, want to pay attention to these reversal candles. These are usually going to be the capping candle that is the trigger that really is going to force me. And sometimes we see a divergence, you not know if that divergence, but if you see a divergence and a reversal candle, you want to put that 1 tick under the reversal low. Make sure your 1 minute, 5 minute stochastic rotation are headed in the same direction. And maybe even take a look at that 60 minute stochastic, because that would be a big plus if that was in your favor too. And then multiple time frames using the tradeometer is great for that. That's a multiple time frame indicator. You got that also for next week. And not to, of course, we're going to have the Rockbot running, which has given us so many good setups. Now, I've told you today a couple times. Let me see if I can bring this over for you. I don't know if I can or not. I'm going to try my best. This is the Rockbot. Now, again, if you have this on your own platform because you're a lifetime member and you're able to run it, you have the Ninja platform, then you could run it any way you want and you can change the parameters. I set up the parameters here in a certain way, but the fact is it really does identify the divergences. It identifies the divergences so good that we tend to see bigger moves from these levels. Not to say that sometimes we don't get chopped up and stopped out, and I really believe that is that's the thing that we can't really program in as much, because what happens is if there is a divergence and other people are divergence traders, they might put their stops in right under certain candles, and lots of times, sometimes we'll see a candle flick down there and take out highs, and we'll get these running divergences, and it's almost like the algorithms know where to go and we'll search out. But most likely, if you get a divergence long, even if you come back to it a little, it usually within 10 minutes, I always say, the market moves up from that buy signal, moves down from that short signal. All right, so you can see this was kind of just a choppy area. I got a buy divergence here, and it moved up. Now, very, very, very tight stop. I mean, if I had if I'm in this and I get an alert, I probably will understand this pattern a little bit more and say, all right, the 5-minute time frame's on our side. I want to hold it, and I'll let it pull back. Right now, it has a trailing stop. Right when it hits first target, it moves up to trailing stop, and lots of times the market will come back down and test that. So it's really at the point of using this, I want to use it. I want to be able to get those entries, but I also want to make have that hands-on thing. Now in this case, you had some news that came out, and the market just dropped off hard. But other times you will see that, and there's also shorts on this too. But you'll see that it's not it could get choppy when the things are choppy, or understanding where the trend is. You have to be careful of that too. If you're in a pretty strong downtrend and it's trying to hit the longs, there's a chance that they won't get the bigger bounces that you want. And again, like I said, this is a very tight stop on this. So even though you get a big move like this big candle probably comes up and grabs the stop here. It gets the signal, but it's such big wicks that you look back at it. Like I said, it's usually a good spot. So that's why we're going to use this as entry, just alarms, knowing that there might be a divergence. It won't get biased if it registers. And again, this is a 5-minute time frame. I'll also be trading a 1 minute, but as we're trading a 1 minute and the bot is going off and it gives us a 5 minute and you're in a 1 minute, you want to stay in that, or you might want to even adjust it in some way. So all these things I'm just going to use together to make our determination of each trade, and that's going to be a fun week next week doing all this. So I have the playbook trades that we're going to be taking. The calculator we're going to be using. I'll be giving that out. Again, the RockBot will be on the RockBot channel, but I'll have access to that, and we'll be using all that, and you'll get the real good feel of that. And we'll be going over the webinar. I'll be doing it live with you, so I'll be showing the reversal candles happening. Basically what I did this week is kind of read the market as it was going on. We were able to identify a couple of these good divergences. Here was a nice divergence on the trend line. It pulled back. That was something pretty good. There wasn't much there. There might have been a double. No, it wasn't there. But and then I go back and I look at this and I say, all right, if I'm going to be staring at this computer really in depth, if I want to really do that, I want to look back here and I want to see how many times would I've gotten, like here you have a low here and a low here. There was actually a little divergence happening there. Now the divergence is the slight angle between the low when the price was higher than the price, and then the lower low, and the stochastics are higher at that point with the with the lower low. So there was a hidden divergence, and I always say the steeper the divergence, the better. But it's under 20, and does it make me take that? I said, wow, that was a pretty decent. We might want to take that setup. We could concentrate on, feel the vibe of the market, feel that candle, and see there's a slight up curve to this. I'm willing to take those slight up curves, happening, and when it's all happening and going, we might not see it, but sometimes when we look back and we say, all right, here's a little pullback. Look at this. There was a divergence there. Maybe it didn't qualify. Maybe it was under the 20 line, but it was a divergence, because every other time you got these moves are down. These are down or sideways or down. The only time we're looking at divergence is when that higher low on the stochastics and the lower low on the price. And you really want to be able to see that angle. And every time you do, the odds are 9 out of 10 times you're going to see a move in the direction of things. So we're going to concentrate on all those. I mean, to the point where you're watching me now, I'm like, is this lower than low? And if it's not, it's not. We might miss some good ones because here the 14.3 is not doing. I might miss that right there, but I wouldn't miss it because I'd probably start to see that we were pretty embedded here on that 60-10. That's the other trade we're going to be looking for, these flags. So if you have a nice move up and the market is holding the 20-period moving average as this gets down under 20 and this is holding above 80, we're taking that trade up and we're getting out of it pretty fast. We'll take a point, 2 points, 3 points out of it, whatever we get out of it. Because this is a high probability flag, and we know how to identify it. If you see it, you got to believe it. Especially like this. How many times did I tell you, hey, rotation, this is pinned, we're holding the 20, we're chopping around the 20. I know sometimes I say, oh, we're not on the 20, drop through a little, maybe I'll talk myself out of it. If it gets right back over that 20, you start to see turning back up, this embedded, you're going higher. Only if it's for 2 points. And if you're 2 points on it, a good, three contracts or 2 contracts, you're looking for $20 trades here and there. That's a $20 pickup right there. Position size, well, actually even more. How many? It really depends on what you're holding. That's what we want to. But again, I would like to. Let me get back to that chart. Lost my chart. I would like to also identify and kind of put into the thing like which ones do you take the 4 contracts versus the 2 contracts. If you broke down here, the reason you want to sometimes start off with 2, you're in the right area. You might come down a little bit further, or you come underneath the 20 for a second. You're trying to buy that as it gets oversold. You're in a little earlier, but then it starts to move. Then you add to your 2, and if you want to do it that way. What did I have here? I was going to show you something else. This is another thing. Sometimes you think about in a way of if you had 3 contracts on and you're only getting 1.5 points, you're making $23 each trade. It's not a big risk. I think we could get most of these things are going to be multiple points if we could hold on to them. The 4 plus points in most cases, I would guess. Some setups we got to recognize on the 5-minute time frame that we might recognize that we might hit the low of the day. And we have to really consider just stepping away and letting it go, maybe putting a stop in and giving that some time to go. So there's a lot of things to be, that need to be balanced out and taken on at the time. Here's another one. Nice double bottom. I can see this here slowly getting a little higher there. It's almost an 8% little angle. You can see it here too. And that's, and after it's pulled back, another thing is how far away is it from the 20-period moving average. Further away from the 20, the better. So that qualified too. And I'm not even looking at the sell side divergences. And again, all these need to be taken very short term. I'm talking $20 trades. If we could identify and say, hey, this is a pretty good one, you get in here, it's at 88, well, yeah, it went down to 82. Like I said, you're getting pretty decent moves on these. That was a pretty decent sell side divergence. It really was. And let's be honest, when we try to say, all right, how do we know we're going to get in at the right time? You got to make that decision here. So if I'm looking at probably about here, that one big candle, after that rollover, yeah, I'd say you're in about here, 86. You get, 80, yeah. Divergence is going to give you bigger moves, This is almost a double bottom here. Sometimes when you see the candle bodies line up, and the tails, you don't count the tails, but if it's candle bodies closing, opening prices, the bodies line up. They have equal bodies on the bottom. And it's totally out of whack on the stochastics. That's also typically a good situation there. You could smell something kind of happening here. There was a nice trend line. This was overnight too, and I remember coming in this morning and saying, "Oh my God, look at that perfect bounce." This was a trend line that I put in, and it was a really nice one. It went from this 1, 2, 3 pattern, and yeah, well, anyway, it worked out. It worked out pretty good. So you get the drift here. Now this at 245. I didn't see it. I'm looking to see if that was a 5-minute divergence. Sometimes it didn't show up as one, but it did show up as a really good 14-3 divergence here, and that should have been taken, even though it wasn't. It was a 932. There was a slight angle to it, a very slight angle. And again, my reasoning behind the 20 is the ones that are steeper and above the 20 are a little bit safer. So I always taught that first. As you become more, advanced in trading and understanding, and you start to see this, that's okay to adjust it, but the key here is really the higher low, because that is mathematically telling us that the price internally is changing as the stock is still trading, but we're starting to see a change in the way the stock is slowly closing. All right, it's closing high, so it's starting now to close at the top of the part of the highs, and we got that nice little rally going. So it's just a matter of waiting for the thing, and I mean it's easy now, right? It's easy now looking back at it and saying, all right, yeah, I see that. He's right. That was a divergence. Was that a divergence? That was a flag. Yeah, everything worked out. So why, why aren't we taking these every single day? Well, that's the plan next week. That is the plan next week. My plan is to trade these as much as I can next week. I apologize to the stock traders, but hopefully we could all gain from this and really get some, and see how the numbers come out. Maybe make it a more of a full-time thing if I can handle that. Doing both, because right now I think it's a better trade than trying to capture this market, pushing at highs and coming into some, tricky areas coming into October. September, October, there's the drums are beating out there, and therefore a market pullback. But we're not going to forget about the shorts on this, all right? Here was actually a 40 10 divergence. Maybe double top. Very little. I don't know. I wouldn't have probably taken that. But I don't see anything that didn't really work. So that's really excites me for Monday. And I hope that if you have any questions getting started, please email me. I'll keep an eye out for my emails, even though normally I'm lacking on that. And we'll take care of business on Monday. There was anything else I wanted to share with you. Let me see. Well, this is the School of Stock. All right, so on the School of Stock, I have a lot on the divergence course. I will be going over a lot of this stuff. All right, so it's going to be good. You get a good idea of what on the divergence course. It's tremendous stuff on this. There's so much information. Position size and trade the right time frame. A lot of them are just videos. A lot of them are updated examples. Yeah, I always put all the good examples up there. These big divergences and drops. Look at that one. And a lot of times that channel breakdown, divergence, reversal candle, back up through the channel. Boom. A little higher low there, you see it. Lower low here, you see it. Little moves here and there. We see these patterns all the time. These are even on the daily charts. So, let's see what else I have on this. All right, I think this is a video. This is probably a good video too. It's what defeats a divergence, and this is what we have to watch for on you know, just not to get run over on a very bullish market. Lots of times we'll see a divergence and turn into a flag, and if that divergence turns into a flag, you have to be very, very fast on getting out of that divergence setup. So I'm looking for one that will give you an example. There was a couple this week, and I made a good call on one of them because I was short or long, or I saw the flag and decided to get out of it. It worked out. It went higher. It doesn't come up that much, but when it does, that's what we pay attention to. Oh, I'm not going to waste your time looking for it here. All right, we're just going to get set up for next week. All right, I want to get this out. Hopefully you, and again, we're going to probably start early. We always look for divergence and reversals, usually, you know, between around 10 to 11. Sometimes even, you know, it could be 9:30, fast little reversal to 9:50. But around that 10 o'clock to 11, that first hour, we want to really be part of the market and see if there's any big divergences too. All these are going to add in. All right, enough of me talking. I think I just wanted to talk today. Hey, I also want to mention something. I'll mention it Monday, but we lost another member. Trade for Pay, Joel, passed away. I think a couple of days ago. I just got the note, and he was a long-time member here. Great guy. Met him many times, at least. Yeah. I mean, I met him down in New York when he came down, and we were at the NASDAQ, and I think I met him I don't know if we met in Vegas enough, but, you know, it was always good times, and he was a great person here in the chat room. So my thoughts and wishes go out to his family, and I know a lot of you out there know Joel. Trade for Pay. Rest in peace, buddy. All right, I'm going to send this out, and I'll see you guys Monday.